Hello and welcome to the Guernsey Finance podcast, where we bring you interviews with leaders from the global finance industry, as well as news and developments from Guernsey's financial services sector. My name is Brandon Ashplant and I'm Technical Manager, Funds and Private Wealth here at Guernsey Finance. For those of you who aren't familiar with Guernsey, the island is a leading global finance centre. The success of the industry here is underpinned by economic substance, political stability and asset security, and we are committed to the cause of sustainable finance. To find out more about Guernsey's success in sustainable finance, tune into our sister podcast, the Sustainable Finance Guernsey podcast. Today, I am delighted to be joined by Martyn Dorey, founder and managing director of Dorey Financial Modelling. Great to have you with us. Prior to founding Dorey Financial Modelling, Martyn spent several years working at leading investment consultants, consulting to large pension schemes, including beginning his career at Baker & Woodrow, moving to Aon, and finally at PRIIP. Martyn has served as the president of Guernsey's Chamber of Commerce and currently serves as an executive committee member of the Guernsey Investment and Funds Association, otherwise known to local industry members as GIFA. Dorey Financial Modelling have conducted research into the nature of the IPO market, particularly with regard to activity we're seeing in London. The firm has analysed 270 listed funds and trusts across the UK and the Channel Islands, grading the quality of the packaged retail investment and insurance product. Key investment documents, commonly referred to as PRIIP KID disclosures. A PRIIP KID is a mandatory standardised disclosure document designed to give essential information about the PRIIP to the retail investors about the risks or the potential risks and rewards. Financial products falling within the scope of PRIIPs can only be sold if a KID has been provided to investors. In this episode, we'll be discussing some of that research and those key findings behind it conducted by Dorey Financial Modelling. So without further ado, welcome Martyn.
Hi, thanks for inviting me on the podcast.
Great to have you. Firstly, obviously I've just done a bit of an intro into who you are and your career today, but just tell us, for those listeners who don't know, about you, how you came to found Dorey Financial Modelling, and just a bit about your career to date.
Yeah, so I started in industry in 1996 working for Baker & Woodrow in London. And I was put into the research team there. I got to work on some fascinating projects, such as helping build the FTSE Multinational Index, looking at companies which are multinational in nature. I also worked on one of the largest court cases in the time, supporting Unilever against Merrill Lynch, and there was a out-of-court settlement in favour of actually Unilever. And that related a lot to disclosures about risk and performance. But it was reported to be in the order of about sort of £76 million settlement. And that really was a wake-up call to me about the role of research and getting to the bottom of knotty problems. But I worked for Aon, helped set up their multi-manager fund. That launched with about 500 million back in sort of the early 2000s. And then I joined a company called PSolve in 2003. And I worked on all sorts of really interesting projects. And I had a very stimulating managing director called Mike Faulkner, who always used to push me to think harder and further and out the box on new ideas and thinking. And he challenged me on being too stuck in the past. And you know, forget all your actuarial nonsense. What's really happening on the street? And it really opened my eyes. And when PSolve floated with River and Mercantile, I had the opportunity to set up my own business and have some of the wider group, which was Punter and Southall and Sanlam at the time, as my initial clients. And we've grown. We've got about 250 clients around the globe, supporting with knotty investment problems, such as how do you communicate your risks and your rewards to investors, as well as supporting the states of Guernsey with economic modelling and other jurisdictions further afield. It's been absolutely, I've been very lucky to be involved in, if you like, the research side of investment.
Interesting. And just if I may, how did why Guernsey all those years ago?
Yeah, well, I grew up in Guernsey and my family's from Guernsey. I couldn't bear for the kids to grow up anywhere else. It's a wonderful environment. It's also very stimulating when you're surrounded by nature and you cycle into work and you cycle back from work and you're not inhaling fumes from cars. It's really stimulating and it's really social. And one of the things I found when I moved back to Guernsey was people look after themselves a lot better here. A lot of your friends will be engaging in sport and all these wonderfully healthy things. And I got accidentally pulled into doing running and swimming, which I'd never dreamed I'd do in a million years. But because there's such a strong outside culture here, you just get pulled into it.
Brilliant. So tell us about the research. What were the aims and the objectives going in?
Yeah, so we service about 240 clients with reporting, and a subset of them are UK based. And the FCA came out with what's called a forbearance statement and said, look, if you're a listed fund, we're going to make it so that you don't have to do these kids' PRIIPs reporting as long as you report the key things elsewhere. But we're going to have a think about what the new regulation is going to look like. Now, the new regulation is called the Consumer Composite Investment Regulation, CCI. And they know they need to do some standardisation of reporting on risks and costs. And they said, while we're thinking about it, we're going to draft some legislation, we're going to publish it, and we'd like to know what you think. And we went very, very deeply into it, and we thought, what's working and what isn't? What's effectively a tax on investment companies? What actually is improving market efficiency and making the game better for everyone? And we've heard an enormous number of myths in industry, like if I publish my costs, I'm disadvantaging myself because my competitor's not publishing their costs. So if I do that too, surely I'm in a worse position. Surely I have to set my costs to zero when I publish a document. And if your competitor's doing it, damn it, I've got to do it too. So a lot of people have been caught in this comparative trap. But what's real and what's imaginary? And that's what we wanted to get to the bottom of. So we analysed 270 funds in the market, and we graded these 270 funds on how they're reporting costs, how they're reporting risk, and we came to some really interesting conclusions.
Interesting. And I suppose in overview that leads to the next question I have, which was, what did you uncover? What were the sort of the headline findings?
Yeah, the headline findings were really that there's this thing called discount rates that affect trusts. So there's the value of the assets and there's the value at which it trades at. Now, what's interesting is that because investment trusts are traded, we get to see the things that affect discount rates. What actually do investors like and what don't they like? If investors are very keen on you have a narrow discount rate. So the fund's assets might be worth 100 million and the fund itself is trading for 100 million. Or the investors might price in a little bit of uncertainty or a little bit of doubt about what might happen. And in that case, you might see your 100 million fund now trading at 80 million. So there's a gap, and that gap is called a discount rate. And when it's narrower, your fund's liked more by the market, and when it's wider, your fund's liked less by the market. And what we found is that there's three things that seem to affect discount rates. The first thing is the economic environment. The second thing is if you've got a high-cost fund, investors don't like that. And the third thing is transparency. So how transparent are you being with your costs? How transparent are you being with your risks? And how believable are your return expectations? And interestingly, economics is the most important driver of discount rates, things like interest rates. But you might think that fees might be the next most important thing, but it's not. Actually, the next most dominant thing we found was transparency. And what we found was quite clear evidence that if you're really transparent, it doesn't even matter what your costs are. Investors just like you for being honest and being clear and believable.
Interesting. And many listeners will be no doubt aware of sort of recent, I suppose, uncertainties in the global macroeconomy, but obviously that extends to the UK economy as well, and sort of the impact on sort of financial instruments such as gilts and mortgages. Could you just talk a bit about some of those factors that have driven this uncertainty? Yeah,
so the world basically moves through economic phases of growth, overheat when everyone's getting too exuberant about stuff. And sometimes it might be specific sectors where you have exuberance. Then you move through a contraction where interest rates go up and they try and famously take the punch bowl away from the party just as the party gets going. And then you have recovery, and then you head back into growth. Now, what we've seen is that over the last couple of years, in a sort of post-COVID environment, we've been struggling flipping between overheat, when there's prices are rocketing up, and then back into fears of contraction. But recently, we're moving from contraction into what I call growth. And we think it's about 80% odds on that we're now moving into a growth environment. And it's this time when typically you'd expect people starting to gently move back into putting funds on the market, IPOs, getting ideas going, investment starting to lift off again. Everything we've seen with low levels of IPOs in the UK markets is entirely consistent with the economic cycle. So we're confident that the future is going to be better and more optimistic than necessarily the market feels in previous years. But that's did you have any sort of particular areas that you were thinking?
Well, I suppose to some extent there's no secret that the IPO market has been fairly dry over the last several years. It goes without saying that actually and many of our listeners will be aware that Guernsey, as one of the prime jurisdictions outside the UK, has more listings on the London Stock Exchange than any non-UK jurisdiction. So clearly Guernsey is doing something different and right, but it's still a case of looking at the wider sort of macro, looking at the situation through a macro lens and thinking what's actually going on here.
Through a macro lens, we are heading into the growth period. So things will get better even though they don't feel great at the moment. And discount rates will narrow because of improving fundamental economics. And they'll get to a point where people we're quite happy raising money, because it's not like you're raising £100 million and the next day it's worth 80. Discount rates will narrow because of economics. But we do need to narrow discount rates even further by having standardised and good transparency. In fact, we need to have more trusted markets than our international competitors. And this is why policymakers at the FCA, rather than going, oh, that's European legislation, let's torch it, actually think about how do we make our legislation more efficient and better, particularly for investors. Policy is quite interesting because we really need to see more investment into the UK. So where is the money currently tied up in the UK? There's two main pools of money. One is what you might call DB schemes, where promises are made to pensioners, and the other one's DC, where you put money into a pot and see how you get on. Now, the DB money has transformed over the last decade. So there was a time when DC used to have a large portion of its investments invested in UK equities. Today you'll find about less than 2% of DB money invested in UK equities. This is actually a disaster for UK PLC. And what's happening is this idea of liability-driven investing has taken over, and they're saying to trustees, why are you taking risk? You don't need to take risk off the table. And trustees have gone, good point, why am I taking risk? Let's take risk off the table. And they enter into contracts which are effectively backed by gilts to take risk off the table. And this is called liability-driven investing. And there's currently £1.5 trillion worth of money at the moment tied up in liability-driven investing. This is the equivalent of saying, I'm going to have £1.5 trillion worth of fields. I'm going to look after those fields. But do you know what? I'm not going to grow anything in them. That money is dead to the UK economy. It's literally not doing anything. And this is the biggest travesty in UK policy right now. We need to get investment into the country ASAP. And we need to think harder about why have we allowed ourselves to get into a trap that, go back to Mesopotamia. They said if you had a fallow field, you'd be punished for it. It really is important that the community recognises that this is strategic assets, strategic investments. You know, we got to look at how we align pension scheme members and trustees with the long-term objective of growth, and that will drive investment, that will drive IPOs, and it will really improve the lookout for the markets. And I really think all industry bodies need to be saying to all the policymakers in the UK, what are you doing? This is £1.5 trillion of money. This is the big ticket item. We've got to get that money invested in the UK. So let's say, rather than getting risk off the table, let's define what the right level of risk looks like. And then let's get money invested into UK PLC. Interestingly, on the DC side, there's been what's called some sort of mansion house sort of reforms, which wants to get more money from DC schemes invested in UK PLC. And it'll be about the equivalent of 80-90 billion pounds invested into UK PLC over the coming years. But it won't be as effective as getting money from defined benefit schemes invested. So we need to really work much harder at saying, look, financial economics is great, but actually you've gone too far on this. You're actually, the ancient Mesopotamians wouldn't have stood for this, and nor should we.
As you say, many defined benefit schemes are, now in a sense in a surplus with, yields higher. So I guess sort of trying to look then to the sort of next step, what opportunities and policy initiatives would you be looking, to see come to fruition to move the dial on this? Obviously you touched there on the sort of Mansion House Compact. But what sort of policy initiatives would you like to see come forward that would encourage that sort of reinvestment into sort of into the UK's productive assets?
I think we've got to align pension scheme members with upside. So at the moment, there's no upside for taking risk in a defined benefit pension scheme. If DB schemes get back to the whole purpose of a trust, which is to take risk, to seek return at acceptable levels of risk, that's got to be the fundamental long-term principle we've got to follow. And the way to do it is to say to pension trustees, and more importantly pension scheme members, if a scheme does well, you've got to allow the pension scheme members to get better outcomes. So without that, there's no incentive for upside. See, upside and downside are two sides of a coin. At the moment, it's just about downside. Fun enough, this goes back to work I did in supporting Unilever. There has to be risk to achieve upside, not just looking at downside. And so the best way to encourage people to take sensible levels of risk is to mandate that actually pension schemes need to throw surplus back towards their members so that members' pensions actually go up more over time from taking risk. Now, pension schemes are one of the few parties that can take long-term risks, and it's not about saying go crazy. It's about being sensible, depending on your funding position and the maturity of your scheme. Yes, most pension schemes are paying out money, but for any horizon over 5 years, you really should be taking some level of sensible risk.
And how does this feed into that, going, I guess, kind of shifting gears and going back to where we sort of started this conversation, in a sense of where there's so much upheaval. You look at the stocks and golds it's a surprise in the sense that to some extent the wider trend towards uncertainty would drive the gold price up, but we're in a position now where stocks, ETFs, in a sense, to capture that with gold, are both on the up. So what's going on there? How does this feed into the wider sense of understanding?
Yeah, this is a really interesting point. So we recently did our sort of quarterly market update, and we were asked can you look closely at a couple of conversations, one of which was what's happening with gold. The other one actually was AI, and also what's happening in Ukraine. But if we focus on the gold point for a moment, we do know that the markets have bubbles, and those bubbles break. And people thought they were having a diversified portfolio, and they suddenly find they haven't. And where does gold sit on that? And the question is, what's been driving gold prices? And it's really interesting because over the last year, about half of demand for gold came from jewellery, mainly from Asians buying gold jewellery. The other half is split roughly 50-50 between central banks buying gold for their reserves and also ETFs. Now, over the last year, Poland and Kazakhstan have both been cranking up their gold reserves levels. Kazakhstan because it wants to diversify oil, and Poland because it's worried about geopolitical situation with Russia and also the stability of the dollar. But the US investors have been really active, and they've literally piled into gold not at record levels, but one down from record levels if you think about it over 2025. And that's been motivated by, obviously, are we going to see tariffs on gold? It's been motivated by, how do I diversify my tech exposure? And I'm not sure about the stability of the dollar. Now, the thing about the tech exposure is that bubbles move from one place to another. And suddenly gold not being correlated to tech currently looks like it's correlated to tech because it's going up at the same time. So I would say that I would expect to see much more volatility in gold prices because jewellery demand is very, very sensitive to price. So if everyone in Asia decides, hey, gold's too expensive, I'm not buying gold jewellery, that's half the gold market. The other thing is US investors have been actually quite fickle in their relationship with gold. And we tend to see big flows in and out of gold over the last 10 years from the US. So don't rely on US investors as having a one direction exposure to gold. Oh, there was one thing I probably need to mention, which is generally when interest rates go down, US investors prefer gold. And when interest rates are high, they tend to sell gold and go back into cash effectively. And if, for example, the Fed goes, hang on, tariffs means that everything's more expensive, they may crank up interest rates, and that could lead to a big kick in the pants for gold. But I can tell you that the odds of the Fed increasing interest rates is quite low at the moment.
Interesting. And I guess sort of shifting gears again slightly, but some have described, and we've touched on it a little bit, pension trustees as being in that prudence trap, to use your wordage. Could you explain what that is and how that sort of relates to their, this sense of sort of fiduciary duties and back to that risk appetite conversation? So
the prudence trap is where people just constantly take risk off the table so that there's no upside. And productivity in the UK needs risk. And the UK currently is in a prudence trap where the largest pool of money is stuck chasing zero risk. Now, it's really important that you've got the right balance between upside and downside. And when you're just focusing on downside, you're in a prudence trap. And that's where we are at the moment. And we need to move out. And we need to move out of it by aligning everyone's interests with sensible levels of growth, sensible levels of risk. And that means the regulator rewarding people for taking risk, not punishing them.
How does that feed into the wider transparency point, in a sense? Because that's sort of part of the picture, and tying into back to the research you've conducted.
If we go back to our research, so let's put the economic cycle bit to one side because that will sort itself out. Let's look at the transparency piece. Our data said very clearly that if you've got very clear disclosures which credibly cover cost, risk and return, the market likes it, and it likes it a lot. In fact, for a £250 million fund, we saw that good transparency adds £15 million to the underlying assets, which is terrific. That's just what you want. And the problem is, if you're a statistician or if you talk stats, someone go, it's just statistics. And no one can say what they like by massaging statistics. But it does correlate very strongly with an economic principle. It's called the market for lemons. This American economist is called George Akerlof, and he was looking at the second-hand car market. And the question that people had when they bought a car in the 1970s was, am I buying a lemon, which is a rubbish car, or a peach, which is a brilliant car? And generally, if people don't know whether they're buying a lemon or a peach, they assume they're buying a lemon, which is a rubbish car. And what he saw was collapses in the price for second-hand cars when there was a loss in trust. And his paper was called The Market for Lemons. And it's actually the most quoted economic paper in history. And people have found it everywhere. And what I find astounding is that some of the actions of the FCA have acted completely counter to economic principles. And what our data is telling us is that we need to go back to fundamental economics and think, look, disclosure isn't a tax. It's core and key to making transparent and efficient markets and being attractive places to raise capital. And when a fund manager put zero costs on their disclosures because they don't want to disclose their costs, they get hammered for it in their discount rates. They really do. We saw a very strong relationship between what I call misleading disclosures and investors just not liking that product. So the other thing that was very, very interesting is we saw a Guernsey effect. And we mentioned that, a large swathe of funds on the UK markets are based in Guernsey. But when you look closely at the data, our data said very clearly that Guernsey funds have got narrower discount rates. And I would say that typically the discount rate benefit is equivalent to a £15 million on a £250 million fund. So currently the data's saying if you want to raise money and you want to do it efficiently, you should be doing it from Guernsey. But why is there this Guernsey effect? It's because Guernsey's producing better disclosures. So why are we doing that? And that's a deeper question. Governance, independent directors. Because in Guernsey, directors are much more on the hook for poor disclosures, saying things that aren't true about a fund. Whereas if you look in the UK, it looks like if an investment company says, look, I can say what I like, I don't really care, let's just say what we'll do so we look good against the competition. It looks like they're less on the hook, and that's because the company takes more of the risk rather than the individual directors. And we think this personal responsibility seems to be driving better governance in Guernsey, and that then leads to better, narrower discount rates on funds. And if you look at the independent directors in Guernsey, they're much more likely to be members of the IOD, have diplomas in directorship, etc. A much higher standard of directors than typically you'll find on UK funds. And it's borne out. It's been the golden idea. Can you prove that governance is good? Yes, you absolutely can. And it's because of the market for lemons. If you've got good disclosures, if you're being really honest and transparent with you, that's what investors want. And what we have to do to really drive IPOs is be the most trusted market, the safest pair of hands in Europe, in the world. It's not much to ask for.
No. So Guernsey is a peach, is what you're saying?
Guernsey is a peach, no question.
Shifting gears again slightly, what does this mean in terms of that redefining prudence? So we touched on prudence before, and you noted that the prudence gap, the prudence trap. Yeah. So how might this sort of concept support both financial stability and back to that sort of national economic growth cycle piece?
Yeah, well, the prudence gap will only get solved when the FCA wakes up and says, actually, we need to take sensible levels of risk, not no risk. And the FCA wakes up and says, actually, we need to have credible disclosures. And we need to police them as well. And this is the other thing. See, our industry isn't going to like this. But the truth is, if you police disclosures, you get better quality disclosures. And investors like that. So it's not necessarily just about thinking about it from us in the industry. It's about thinking, what do our investors want? And how do we give investors what generally they want, not what you'd like them to want? So it comes down to policy at the FCA. Really pursue consistency across investment products in terms of reporting, clarity, and credibility. And they need to be policed to be credible.
Interesting. Market conditions, irrespective of industry or sector, clearly impact, the performance of companies, and in this case, listed funds and the IPO market itself. We've talked at length about now. But what are the main three factors influencing that sort of investment trust discount level as they stand?
So just to recap, the three things that affect investment trusts are the economic cycle. And the things that we look at in the investment cycle are really what's central government policy. Are interest rates coming down? Are they going up? What are interest rates? Are they high or low? Yeah. What's the level of volatility in the markets? Because investors don't like volatile conditions. Things like price to earnings, all these sorts of things just give you an overall flavour. But interestingly, what we see on investment trusts is more detail than necessarily get from other investments which aren't, investment trusts, because you have this thing called a discount rate, and the discount rate gives you more information about what's good for the market than necessarily get with a straight listed company. So we're getting more information about the value of transparency and how important it is to raise IPOs. So number one is the economic cycle. Number two is actually, in terms of importance, it is transparency. Do people believe you? Have you credibly explained risk and return? I've spoken to a large number of fund managers who are saying, look, my competitor, he's published 0 on his key investment document, and no one reads them. People do read them. They definitely read them, because we can see it has an impact on market pricing. So what you say does matter. And what we can see is if you don't report your costs or you set your costs to 0, the market doesn't like it. So you may not like reporting your costs, but the market cares more than you do. So we do need to challenge certainly leading voices who want to scrap all disclosures. And we need to move the mindset, say, look, it's not actually a tax. It is a cost, but also it's a benefit because it improves market efficiency. And the third thing was, look, if you've got low costs for a fund, that clearly helps, but not as much as transparency, which can override your underlying costs.
So actually, in a sense, probably tipped on the head in terms of where you think the lay of the land would be. Actually, your research suggests.
Yeah, economics, number one. Number two, transparency. 3, costs. And what is really great is that it's with everyone's gift to report better and more credibly. This is something that everyone's in control of.
And you've spoken about the importance of the quality of, the PRIIPs, the key information docs, the KID disclosures, to spell it out for those who are less familiar. Can you explain just in a bit more detail, what this is and the impacts of sort of investor confidence and the market valuation of investment trusts against, what that means?
Yeah. So the world's moving in a direction when people want more information, not less. We're moving to a world of AI. Data needs to move around the markets much more efficiently. And we've had all sorts of problems where platforms have been reporting costs wrongly, and that's impacted on certainly the confidence of investment trust managers. So that needs to be looked at. But the broader story is that you need to be able to report on cost, risk, and what you think the product's going to do in the future. And this needs to address a few key areas. This goes back to the market for lemons, which is investors are worried. They're generally worried that high-cost products are being passed off as low-cost products. Investors are generally worried that high-risk products are being passed off as low-risk products. And investors don't really understand the relationship between risk and return. Certainly all the data that we've looked at has said, look, don't assume that a knowledgeable investor really understands the relationship between risk and return, because certainly when we've been looking at questionnaires, we haven't seen that investors actually, of any level of sophistication, get it. So it's critical for certainly an investment trust to protect itself and to protect the investor by saying, look, you may read this, you may not. Someone's going to read it somewhere, but we need to put a marker in the sand that these are the risks of a product and these are the costs we're going to be charging. What's missing from current reporting is consistency, because if a fund does very well, you'd expect it to pay more carried interest. And if a fund doesn't do so well, again, the fees will go down. But these are the things that investors need to know. And another key area, which is actually not just the costs, but the benefits. We found that, for example, the tax relief from investment trusts can massively outweigh the costs. We looked at some large private equity companies where they published very precise detail about how rebates from capital gains tax was fed back into the fund and it helped drive returns. And it was substantial. The tax relief from being an investment trust outweighed all the costs that fell the fund. And these things need to be communicated to investors too. So when we went back to the FCA and the FCA said, what do you think about the direction of travel? We said, it's not just about reporting costs, you've got to report benefits. These fact sheets aren't just about telling people what can go wrong. It's also got to help sell industry too and sell the benefits of being an investment trust.
And just a final question. You talked about the Guernsey effect a little bit earlier on. What factors contribute to sort of Guernsey-based investment funds performing well? And what is the Guernsey effect in its essence?
In its essence, I think it's the quality of governance. Everything points to good governance, and the magic fairy dust, the little sprinkling on top, is the fact that the directors are independent and they are accountable, and that leads to better outcomes for investors.
Brilliant. That's all we have time for, but thank you very much, Martyn, for joining us on the podcast to discuss your research.
Thank you.
Thanks also to you for listening. If you enjoyed this discussion, we have an extensive back catalogue of interviews on the Guernsey Finance podcast channel. You can check them out by searching for Guernsey Finance on your preferred podcast platform. We also have links to Martyn Dorey Financial Modelling in our show notes. To find out more about Guernsey and its specialist financial services sector, head over to our website, guernseyfinance.com. We look forward to welcoming you back to the podcast soon, but until then, it's goodbye from Guernsey.